Today, we're diving deep into a really interesting Canadian company that has been on an absolute rocket ship lately, TerraVest Industries. We're going to break down its incredible growth story, but we're going to do it from an investor's point of view. Okay, let's get right into it.
So let me just ask you this. What if you found a company and in just 4 years, about the time between one World Cup and the next, its sales didn't just grow, they tripled? That is the kind of explosive growth that every investor dreams about finding, right? Well, this isn't some hypothetical classroom exercise. This is the real deal. TerraVest Industries actually pulled it off. And you can see the scale of this thing right here. I mean, the numbers speak for themselves. We're looking at a jump from around $300 million in 2021 to a projected $900 million plus by the end of fiscal 2024. That acceleration is just staggering. It's that classic hockey stick chart that everyone wants to see. And it's all being driven by a very specific, and you could say, a very aggressive strategy.
But that's the real question, isn't it? After a run like that, after a stock has performed so well, is all the good news already baked into the price? Is the company now walking this high wire act where the potential fall is just as dramatic as the climb has been? That's the central conflict we need to figure out. To really get what makes TerraVest tick, you have to understand this one concept, the M&A roll-up. This is their entire playbook. They're not out there inventing some brand new technology from scratch. Nope. They are systematically hunting for and buying smaller, successful companies in their niche and then rolling them all up into one much larger, more powerful organization. That is the engine behind those crazy revenue numbers we just saw. Okay, so let's start with the good stuff, the bull case. Why are investors so excited about this company? What are the fundamental strengths that have propelled it this far and could, take it even higher? And here's what's so smart about their approach. TerraVest isn't trying to be everything to everyone in these massive crowded markets. No, they're going in the other direction. They're dominating very specific, very defensible little niches. They are the #1 maker of home heating oil tanks. They are the top dog in Canadian wellhead equipment. Now, these aren't exactly glamorous industries, but they are absolutely essential, and they have really high barriers to entry. That gives them a super stable foundation to build on. And they are shockingly good at turning capital into profit. A return on equity of 22.5%, that is a fantastic number. It tells you that for every single dollar of shareholder money in the business, the management team is generating over 22 cents in profit. That, my friends, is what highly effective capital deployment looks like. Now, this right here, this is what gets growth investors really excited. A 10% dividend payout ratio. That tells you two really important things. First, the dividend is ridiculously safe. But way more important is the second thing. It means 90 cents of every dollar of profit is being plowed right back into the business to go out and buy more businesses and fuel more growth. It is the absolute hallmark of a true compounding machine. But, and you knew there was a but coming, all of this incredible growth, it doesn't come for free. It comes at a price. And it creates a whole different set of risks that any investor has to get their head around.
So let's flip the coin over and look at the other side, the bear case. This is where we need to unpack the dangers that come packaged with such a rapid, debt-fueled expansion.
And honestly, it all kind of boils down to this one number. Over $500 million for a single acquisition. Intrance. This wasn't just another small roll-up deal. Oh no, this was a massive, transformative, bet the company kind of deal. It fundamentally changed the size and shape of TerraVest. And the risk of trying to integrate a business that large, it's just immense. And here's where you have to peel back the onion a little bit. You see that headline number, 34% total revenue growth, and it looks amazing. But if you strip out all the companies they just bought, what was the growth from their original underlying business? Just 4%. This shows you just how dependent the company is on making deals. TerraVest isn't just growing, it is buying its growth, plain and simple. So, how are they paying for all these deals? Well, a lot of it is debt. And I mean a lot. A debt-to-equity ratio of over 240% is, well, it's pretty high. That kind of leverage can be rocket fuel for your returns on the way up, but it dramatically increases the risk if the economy slows down or if one of these big acquisitions goes sideways. And of course, the market sees all of this growth, and it has priced the stock for absolute perfection. TerraVest is trading at a price-to-earnings ratio of nearly 50. Now compare that to its peers, companies like CES Energy or Trican. They're trading for less than 10 times earnings. That massive premium means the market isn't just hoping for flawless execution, it's demanding it. There is zero room for error priced into this stock.
Okay, so we've got the bull case, we've got the bear case, but there's one more critical piece of data we need to look at. Let's forget the spreadsheets and press releases for a second and ask, what are the people who actually run the company doing with their own money?
You know the old saying, right? Actions speak louder than words? Well, in the stock market, there is no action that speaks louder than when an insider, a top executive, buys or sells shares in their own company. And what we've seen recently is a whole lot of selling. We're talking about the CEO, the executive chairman, the chief investment officer, the very architects of this entire roll-up strategy have all sold millions and millions of dollars worth of their stock. Now look, insiders sell for all sorts of personal reasons, that's true. But the timing and the sheer volume of these sales coming right after a huge run-up in the stock, that is a data point you just cannot ignore.
So this brings us to the final verdict. How does an investor actually weigh this high-octane growth story against these very clear, very present dangers?
It really just boils down to this core trade-off. On one side, you have the bull case, a proven M&A engine that dominates its niches and kicks out some seriously strong profit margins. And on the other side, you have the bear case, a massive integration risk, a balance sheet loaded up with debt, and a sky-high valuation that demands perfection. So that's the ultimate question that you, as an investor, have to answer for yourself. Is TerraVest a brilliant compounding machine that's really just getting started on a long path to greatness? Or is it a high-wire act, priced for perfection, where even the slightest misstep could lead to a spectacular fall? We've laid out the evidence. The final call is yours.